When Silicon Valley Bank collapsed on Friday, it created the second largest bank failure in US history. Here's how it all came tumbling down. On March 10, the bank failed after a run on deposits, prompting federal regulators to step in and limit risk in the broader financial system. This became the largest bank crash since the 2008 financial crisis, and it put nearly $175 billion in customer deposits under the regulators' control. Shock from Silicon Valley's woes reverberated through parts of the banking sector, and investors started to dump bank stocks, including those of First Republic, Signature Bank and Western Alliance. The collapse of Silicon Valley Bank led to the failure of a second bank, Signature Bank, a 24-year-old, New York-based institution that lent largely to real estate companies and law firms. To prevent the spread of banking contagion, regulators seized Signature Bank. To some extent, the bank, which had 40 branches, was a victim of the panic surrounding Silicon Valley Bank. The aftermath of these bank failures has been significant. Treasury Secretary Janet L. Yellen reassured investors that the banking system was resilient, but regional bank stocks plunged, with First Republic taking the worst beating, dropping 60%. Shares of Credit Suisse also tumbled by 24%, a record low, causing fears over the health of the banking industry to resurface. Now, some of you might be wondering what caused the collapse of Silicon Valley Bank in the first place. Well, it all started when the bank announced it needed to shore up its balance sheet and raise $2 billion in capital. This news concerned investors, and the bank was forced to sell a bond portfolio at a $1.8 billion loss. Moody's, a credit ratings firm, downgraded the bank's bond rating and slashed its outlook to negative, from stable. The situation worsened when customer deposits came in lower than forecast in February, and panic spread on social media among investors. Bill Ackman, the billionaire investor, even suggested that Silicon Valley Bank could fail and need a bailout. The bank's CEO, Greg Becker, urged venture capital firms to stay calm, but the damage had been done. Silicon Valley Bank's announcement prompted another wave of customer withdrawals, and its stock plummeted 60%. In the end, Silicon Valley Bank failed after a run on deposits. It reportedly worked with financial advisors until the morning to find a buyer, but regulators took over the bank by midday, making it the largest bank crash since the 2008 financial crisis. The FDIC was named the receiver, and the government invoked a systemic risk exception, which allows them to pay back uninsured depositors to prevent dire consequences for the economy or financial instability. The collapse of Silicon Valley Bank and the subsequent failure of Signature Bank was a wake-up call for regulators and investors alike. It highlighted the potential risks in the financial system and the importance of monitoring banks and their activities. While the failure of these two banks did not cause widespread panic or financial instability, it did prompt regulators to take swift action to contain the fallout and prevent a potential banking contagion. The response from the Federal Reserve, the Treasury Department, and the FDIC reassured depositors that their money was safe and that no taxpayer money would be used to bail out failed banks. However, it also highlighted the need for continued vigilance and oversight to ensure the stability of the banking system and prevent future collapses. As investors and regulators continue to monitor the fallout from these events, it remains to be seen whether the lessons learned will lead to long-term improvements in the banking sector or merely serve as a temporary band-aid on a systemic issue. So, that's the story of Silicon Valley Bank's collapse and its aftermath. Don't forget to hit that like and subscribe button to stay tuned for more finance and investing news. Thanks for watching, and we'll see you in the next one.